people have been on the sidelines, Matt, for over a year. The stock market is near all-time highs. So people, there's a wealth effect, and you're saying, all right, I actually need to allocate some more to real estate, and I want to get in and get the good basis now, not even if the rates are still a little bit high.
Hmm.
I think people are really understanding that basis is so important. Wow. All right. May not come as a surprise to some, but getting the data is fascinating. Right now in 2024, renting a starter home is way more affordable than buying a home in all 50 of the largest metros in the United States. It's an incredible shift in the housing industry and how younger Americans are deciding to build their wealth, where they're going to live, and how they're going to live. Absolutely changing the game. But today on the Great Report, we've got other great articles to get into. A piece from CBRE really asking, is there a window of opportunity right now in commercial real estate? We think that might be the case in multifamily. Let's dig into some of the data. And then from Moody's, talking about cities is there a doom loop for cities across the United States? Are they continuing their march on the decline? And then finally, another piece from Harvard Joint Center for Housing Studies, sticking to this topic of cities and the suburbs. We're actually get into a little bit more data. Where are millennials, which is the largest demographic group? Are they staying in these cities, in these urban environments, or are they getting out of town, moving to the suburbs for a little bit more space? We're going to find out all this and a lot more on the Great Reports. If you're a multifamily investor, active, passive, you're in the right spots. Every single week, we are breaking down all the latest research, data, articles, and bringing you the best original opinions in the commercial real estate sector. Joined again today, Dr. Matt Bosnagel, Director of Communications and Marketing here at Gray Capital. Let's get into it. All right, everyone, bringing it right back in. Matt, how's it going?
Hey, pretty good. We miss you here, but it looks like you're having a nice, serene time on the beach right now. So that's great.
Yes. Yeah. At the trailer by the beach, or at least that's what this overlay, it is titled. But yep, I am on location, Matt, in sunny Florida Keys right now with the family. But that is not letting me it's not getting in the way of covering what's going on in the housing industry, commercial real estate, because things have been moving, and it's an exciting time to say the least. You put together really great collection of new articles and research that I'm excited to get into. First off, though, how have you been doing? What's it like back in Indianapolis? What's the news?
There's wailing and gnashing of teeth whenever Spencer's gone. We all stop working.
Yeah, that's what I figured.
We all stop working, and then we all start crying, and then when you come back, everything comes alive again. But I think no. But honestly, it's been busy, and it has been kind of exciting. I know, I don't want to steal your thunder a little bit, but we're progressing with our own deal. Really, we're at an exciting moment right now, and then really in the market in general, it looks like people are poised in a way that they weren't maybe a month or two ago. I know we were optimistic, but it now just seems like people are ready to strike, ready to buy or sell or whatever, or at least they're talking about it. So that's the kind of vibe check that I've got.
And it's a little bit of a self-fulfilling prophecy, isn't it? I mean, if everyone decides like, all right, now is the time to get back into the market, and realizing, I don't know, maybe everyone listened to the Great Report the last couple of weeks, Matt, because we've talked about it a handful of times, really over the last month and a half, of saying, all right, now is the and we're going to be talking about this in the CBRE piece. So I don't want to steal too much of its thunder, but there may be an opportunity right now to get in because of all the dry powder that's sitting on the sidelines, the interest in commercial real estate, especially multifamily. You can lump industrial in there as well as a really kind of hot asset class that people are really trying to continue to allocate to. People have been on the sidelines, Matt, for over a year. The stock market is near all-time highs. So people, there's a wealth effect. People are like, all right, I need to diversify away. And we witnessed the opposite of this at the beginning of 2023, and also a little bit in 2022, of where people, were looking at their stock portfolio and they were down.
Yeah.
And there's that psychological effect, but also be thinking about it from like a portfolio balancing and weighting standpoint. If you're trying to keep balance in your portfolio, if you're doing it yourself or working with your financial advisor, if your if your equity, public equities portfolio is taking a hit, all of a sudden, the asset value relative to real estate, all of a sudden you're going to be maybe overweighted real estate. Maybe you're targeting,
Mhm.
25,
Oh, that's
30%
a good point.
to real estate. Stocks go down, all of a sudden you're at 40%. They're like, hey, we can't add any more to real estate right now. Opposite is happening right now. Stocks are going up. Your target's 25%, portfolio allocation to real estate. Maybe it's 40%. Stocks go up. Now if you're shooting for 25, now you're at 15, 20, and you're saying, all right, I actually need to allocate some more to real estate. And then when you look around at the market and say, okay, well, we don't know when interest rates are going to come down, but I believe that they will come down. And I want to get in and get the good basis now, not even if the rates are still a little bit high.
Mhm.
I think people are really understanding that basis is so important and getting that cost in, because even
Yeah.
though financing is huge and you're still going to have to bring more equity to the table because of the higher interest rates, it's better to lock in a really solid basis at maybe even a higher rate that you can refinance out of in a couple of years
Mhm.
than waiting for the rates to come down, but the prices are up. Where so the returns may not really be any better. They may actually be worse, even with lower interest rates. Much rather take that opportunity to refinance. So people are playing catch up. And I've heard this from brokers as well, is they're getting a lot more buyers reaching out to them, trying to
Yep.
find opportunities, but there's not a lot on the market. That's the problem. There's
Mhm.
not a whole lot on the market still, but the difference is this year compared to last year is the
Yeah.
prices are certainly different. Prices are down 15 to 30%,
That
depending on
was
where you're
the
looking.
and again, to reference the CBRE thing, but that was the quote that I came away with for that whole article, was that like sellers are increasingly aware that they must meet the market to trade. That's that is what they were not in 2023. And I also liked your point earlier when you talked about, and I think it's really interesting, it's something that I hadn't thought about, was you're an investor. If the value of your stocks have gone up, then you need to rebalance in order to stay diversified and go into real estate. It seems a little bit counterintuitive, like, oh, your stock value is going up, so let's get more of that stuff that's doing well. But no, if they want to de-risk and be diversified, they're going to have to devote some capital to real estate. Yeah, I think that's interesting. It's like this
Yeah.
mechanical thing that happens.
And you'll see it happen automatically in the stock market.
Hmm.
Like the year ends, people are doing tax loss harvesting and reallocating the portfolio, and you can see volatility in the market because of selling, but it's not necessarily because things are bad. It's just people are just
Yeah.
shifting things around. And so I'd expect that we continue to see more of that. Again, the stock market's up here, it's high,
Hmm.
real estate prices are low,
Yeah.
so selling some of your stock portfolio off, or maybe you're selling call options or whatever you want to do to hedge hedge the future, generate some income, and then allocate some of the real estate, get that back in balance. Buy low, sell high.
Yeah.
It's as simple as that, and we've been talking about that a lot this year. Let's really need to simplify things and not
Yeah.
overcomplicate. A lot of the overcomplication and financial engineering is how we got into some of this mess and volatility and uncertainty in the first place, whether that's for multifamily borrowers or the Federal Reserve or
Hmm.
Congress, banks. Regardless, Matt, let's go to that CBRE piece next, because
Yeah.
we're on the
Why
topic, and
not?
we'll move to the realtor.com piece
Okay.
second. So let me just pull this interesting piece from CBRE, which is assessing investor sentiment, a window of opportunity. They don't call this they don't have a question mark there.
Yeah.
It's a statement, more or less. And now with a caveat, Matt, that CBRE has put out a handful of pieces in the last year or so. Over the last about 12, 8 to 12 months, really, they want the market to come back.
Yep.
Which who wouldn't,
Hmm.
especially if you're in the business of selling commercial real estate. Again, I think it was about probably going back 8 months ago now, Matt, maybe only 6, but they basically said that cap rates were no longer expanding,
Hmm.
and they're kind of just stable. Which in retrospect, I think they were a little bit early, and at the time it seemed early.
Mhm.
Now, I think that they probably were, but now it's starting to ring a little bit more true, and I'm a little bit more aligned with the sentiment that they're talking about in this piece. But what were some
Yeah.
of your takeaways?
No, I think I totally agree. And I really do admire CBRE because they always take like these solid points. They're not saying like, oh, this could happen. They're like, no, this is what we think will happen. And they may not be completely on point for like every single time, but they always have a good logical basis for their conclusions. And I think that they have a particularly compelling argument in this one. And it really does seem like kind of the winds are changing. This is a follow-up on they did have a whole investor sentiment survey that they did a few weeks ago, and we covered it here on the Gray Report. But there are some powerful implications in that quote that I said earlier about sellers more willing to come to market at a lower price. I think that could really that's really what things are hinging on. And as frustrated as I was talking like every week in 2023 about sellers, it does seem like there's a little bit more. Not like capitulation, but it's definitely things are getting more realistic and less like living in fantasy world. It seems like in the minds of sellers. But I also, it is worth noting that right under that statement is our comments about investors wanting to get these value prices. So core buyers are ready to come off the sidelines at core plus pricing, and core plus buyers want to get in for value add pricing, and value add one wants to get even steeper discounts. I'm not sure what the distinction is between buyers being quiet for the past year and a half, and because it says that, oh yes, there are what does it say here? Core buyers that have been quiet in the last 18 to 24 months they're ready to come off the sidelines at core plus pricing. Well, yeah, if they had that pricing a year and a half ago, they'd still come off the sidelines. So I think that I do like their characterization. We're still at a moment in the market right now where there's maybe a tier, a tier or half a tier value that these investors are looking for, and maybe in some cases expecting that the sellers may not be quite there yet. But I still think if and using the clock analogy that you've described to me before, if midnight or if 12 o'clock is the top of the market, top pricing, and 6 o'clock is the bottom we're maybe at 5 o'clock. I think maybe there's a little bit more of a dip that could happen, and it may have already happened, and because we're all looking at things in the past and when it comes to values.
We may be at 5 o'clock. We may be at 7 o'clock now.
Yeah.
I mean, that's the thing. And that hour hand is like swishes through, it's not exactly in sync. It moves pretty quick, I guess, everything's relative.
And that was the huge key point. I think that probably like the most powerful point that they made in that article was like, there are people that are pretty convinced that you could miss this if you wait too long. Like I'm pulling up the specific quote here right now, but it says, the window of opportunity for deep value investing may not stay open for as long as some believe. Ludeman thinks that some investors may wish they had been more aggressive in 2024 and early 2025. We've been saying that. I don't know if they are watching, not just Ludeman, but maybe Gray and Bosnov have also been saying that too. Is this is a window? It may not look like it, but it really is for people looking for, like you said, a strong basis. It is definitely masked by elevated interest rates, but here's hoping that they're not going to stay elevated forever.
There's a lot, and Carl Whitaker and I talked about this too, but there's a lot of things that are relatively they're negative, but they're relatively, to use a phrase that was used a couple of years ago, transient, occurrences and issues, such as slower rents, high supply, high interest rates, and not as much deals on the market. These are all short-term, temporary phenomenon that the market is working through relatively quickly, and it doesn't really speak when you're thinking about a multi-year, 5-10 year investment. What's happening right now today in the the T minus 6 months uh, into a year of your
Yeah.
investment period, you're talking about, less, you're talking about like a 20th over a 10-year hold that you're concerned about,
Yeah.
and not year 3 or year 4, when there's a strong possibility that things really pick up and it could really turn into a great environment. It could even be before then, as supply starts to wane. There's a lot of articles coming on right now. RealPage just had one, Matt, about how we're going to be this housing crisis is going to get really bad because of permits are starting to decline. We're going to
Yeah.
see starts declining, and we're just not going to be able to keep up with the amount of housing that we need, and that's going to drive rent growth as demand, as we're going to talk about in this realtor.com piece. The demand for rentals isn't going away anytime soon because of the relative affordability compared to single family homes, household formation, millennials having kids, wanting their own place. So it's you need to be ready. You have to take advantage now and try to see. It's like you're playing chess. You can't be just thinking about the first move. You have to be thinking several moves ahead, and that's really difficult. But you can at least think 1 or 2 moves ahead. You're always going to be on the defense. And so now, in our opinion, it's time to play offense and get in there before deals get even skinnier. Now, of course, there's issues with loan maturities and things like that is going to put some pressure to sell. But again, there's so many bids out there on deals that, again, it's not like the core buyers need value add pricing. The core buyers need core plus pricing, which means they don't need which means basically, where they would typically, be okay with call it a 4.5 cap. They want to see a 5 cap, and where the core plus, they may take a 5. Now they want 5.5, or more.
Totally.
And the value add, maybe they would take a 5.5. They need a 6, probably 50 basis points.
And honestly, at what moment are core buyers not looking for core plus pricing? There's a big spectrum between
who doesn't want a deal? Because it's like, that makes sense. And they're like, we'd buy it. The pricing's good. It's like, that's always the case, especially if this is your business and this is what you do. You would think so.
My assumption is they're saying that, but then they're also, it's like, well, we're halfway to core plus pricing, so this is a pretty good deal for us still.
And I think that's the thing about what we're seeing across the board is, and you mentioned this earlier, Matt, is we're not so far away. Sellers and buyers are not nearly as far away as they were. Bids are coming in within a reasonable range. Now, things aren't being overbid. We're not seeing deals, come out with a whisper of, call it, 50 million. They're not being bid up to 51. They're usually not even trading at 50, but they're trading at like 49.
Okay.
So it's pretty close.
Yeah.
So, which is a good sign for that the market actually can transact and their buyers are showing up, and sellers are a little bit more confident that they're not, pissing into the wind or something. Bringing things out right now. That's probably not an appropriate analogy, but that's the only thing I could come up with. Let's switch over on the topic of demand and looking at rentals. This realtor.com piece, Matt.
Really brought back a lot of memories.
And so the headline is a little like, this is news. We've been talking about this for over a year now. About at least a year. And because obviously interest rates are high, buying a home, there's not that many homes available on the market. The prices are way up. And so, your mortgage is like, a multiple of what it costs to rent. And even not just an apartment, but even an actual home. And so more people are looking at renting homes rather than buying homes. There's a lot of flexibility, but it's a deal right now as well. Matt, you wrote up a really good piece on this. You have a lot of detailed notes.
So
it's going to be in a blog post. I recommend people check it out. It's a lot of really good stuff. But just start bring us down. They've got some highlights. What are your big takeaways?
I did take like a little bit of an issue with the title because like they're renting a starter home. I'm not like, it made me think, well, okay, so what kind of rent are they measuring here? And I skipped to the bottom of the article and I was like, oh, realtor.com combines townhomes and and single family homes and apartments in their rental figure. So it's not like really what it's a bad title. The rent they measure is that combination, and the cost of buying is more straightforward in this report. It's a cost of a 0 to 2 bedroom home, no bigger. Then if it's bigger, it's more than a starter home. So the replacement title is this, and this is what they should retitle it. If you can, Danielle Hale, if you can hear me, this is February 2024 rental report. No changes there so far. Buying a starter home is more expensive than renting in all 50 metros that we measured. That's all I got to say. Buying a starter home is more expensive than renting a home. But that's a little bit of quibbling. And straight up, the findings here is that the cost of buying a starter home, now this is the monthly mortgage cost I think that they're calculating here, is 60.1% higher than renting one. That's a lot. That is it's close to double, but there's probably some metros where it is double. And you'll see in their numbers down here actually that there are places where you are almost exactly double the price. And I did want to mention, and this is what really brought things back to me, that in our previous coverage of this issue, I mentioned that these comparisons of home ownership versus rental costs, there is like an important caveat that I think is worth making, and that's the majority of the time I spent on these notes last night was doing these little calculations to square it with the different square footage. Single family homes are typically bigger than apartments, and when you're measuring, okay, yeah, the median home you buy versus the median home that you rent, these studies don't typically adjust for price per square foot. So I did. CoStar has rents so the CoStar average rent is $1,668 a month. Their average size is 883 square foot. So I took the purchase price for 883 square feet. The average purchase price that I've gotten from Realtor.com, it's actually through the Fred website, it's $224 per square foot if you're going to buy it. And if you multiply by that, you get $198,000, so $198,000 home. That's your 883 square foot. Okay. So I plugged that into Rocket Mortgage with a 7% 30-year mortgage rate, 6% down payment. And I added in every year, I guess the rule of thumb is every year you pay 1% of the cost of the house as maintenance costs. So I added that and sliced that into 12-month payments. You could trust my math. You can follow it up on here. I will put this on the blog post so you can actually chase it here. $1,665 a month. That is $3 difference between renting and owning if you do those calculations and if you adjust for square footage. I think that there's more costs when it comes to home ownership. I'm sure I'm leaving something out here because that number is so much different than the Realtor.com.
Well, let me ask you this.
Number.
So I think the biggest, I guess, the pushback I'd have on some of your variables is how expensive do you say the home was?
The home was. Now I plugged this into Rocket Mortgage, so I could be way off, but the cost of the home was $198,000.
I guess my question is are there $198,000 homes out there? There are, but not too many these days.
Yeah. And that's a good point.
And that's and there's so few of those, if any. And if you're buying a $200,000 home, you're going to have to probably put 25 to 50K into it.
And that does kind of get to the point where, like, okay,
you're 100 really.
Yeah, you can adjust for square footage, but that's not the reality. And the
cost is the cost, and
yeah. So and it's because apartment units are typically smaller. That's just the product that's out there. That is what has been established long before.
I think it's good to look at because you're looking at what the value is in the bang for your buck. It's just like when we look at apartment rents. Typically we look at them as per unit because that is how potential renters look at it. They're very rarely looking at a per square foot cost.
Yeah.
But certainly a larger unit has its advantages, and you don't want to compare a 1,500 square foot 2-bedroom to a 800 square foot two bedroom. With similar, if the rents are similar, well, obviously you're getting a lot more value for the
Yeah, yeah,
larger unit. And so that's where that price per square foot comes into play. Obviously, price per square foot is used, in other forms of commercial real estate. That's all you're looking at is, what's the price per square foot. And you
hmm
still want to be aware of it. In multifamily as well. But there is a reason why we're using it's more of like a price per pound, rent per unit, dollar per unit
yeah,
figure that people rarely when they talk about multifamily, like on the buying side, will talk about what you're getting it per foot. You might talk
yeah,
about the rent
hmm
per foot, but not like a purchase price per foot. It's always per unit per door.
yeah,
But
yeah.
still really interesting analysis. So
But
the
yeah,
conclusion, Matt. Yeah,
and
go
so,
ahead.
and that's even not even, I don't think that's the most compelling point in there, because
Mm,
I just wanted to note that square footage, 'cause it was always a nagging question that I had about this
yeah.
comparison. Like, are they really paying attention to this? But the real point is, and far more compelling to me, is that home ownership costs have grown so much faster than rental costs, no matter where they were, no matter what, no matter what they are at this moment. The change that we have experienced really kind of within the past, not only the past 4 years, but really even the past 10 years has been incredible. And so this is the other calculations that I was kind of going with last night as I was getting these notes together. I took Case Shiller and CoStar data on rents and home values,
Mm,
and the trend is just glaringly obvious. So I'm using June 2014 as kind of a decent starting point. It's far enough away from the great financial crisis and that it's not, you're not going to get, it's not like the ideal time to buy. It was just a little bit more of a normalized market at that moment. And then I took it to today. So rents in that time period from June 2014 to now, rents went up 38%. Home values went up 87%. So roughly 2.3x the rate that rent prices increased.
yeah.
And if you actually go sooner, so let's just take the most recent 4 years. If we measure from June of 2020, home values went up 41%. And rents went up 17%, which is just like strikingly similar. It's a little bit more than 2.3x, but it is about that same discrepancy. This divergence has been seemingly there for the past 10 years.
And one of it's fascinating, Matt. And so, but
Yep.
I'm saying also one of these big takeaways is that this problem, it's not, the reality is, it's a continuing trend. It's not
Yeah.
as
Oh, yeah.
though it's not all of a sudden, oh, well, rents are catching up, or what we've
hmm
really been waiting for are home prices to come back down, to come back into
Yeah.
alignment. Um, Home prices, I mean, there's a couple pieces on the cost of the price of new homes that
hmm
have come down year over year. To me, that headline is a little clickbaity, because when you're just talking about brand new homes is different from all home prices, which
Yeah.
is a much more important figure. So you're really kind of cherry picking. It's an interesting stat, and maybe it's a canary in the coal mine, but but the news is that, yeah, the trend is getting worse, and they're highlighting metros that just recently have switched, it flipped
Yeah. Yeah.
from technically, it was still in markets where real estate home prices hadn't gotten crazy. It was still affordable to buy,
Yeah.
more affordable to buy a home a couple months ago, but no longer
Yeah.
the case now
Well,
because rents have gotten cheaper.
yeah. And that is funny. Like the coverage of this, you never really hear, and I feel like an evil fat cat even mentioning that. Oh yeah, you're
Mm,
complaining about rents. Well, you could have it so much worse. Like that sounds evil, but in the okay, so Realtor.com is noticing this divergence, and the industry publications are, but New York Times, the typical article is that you'll read is like, they're going to cite high rent growth, or they'll use that CPI data so that it looks like rent growth is high, and then they'll inveigh against the individuals and companies that are making this high rent growth high. And if you read articles on home prices, they barely mention rent that much, and if they do mention rent, it's like, oh yeah, and here's another bad thing that's happening: rents are also high. The only It does seem like perhaps that the greater public might be kind of getting the picture here, because there was a New York Times article 2 years ago that was more like the stereotype I just described.
mhm.
And a more recent article from the New York Times actually does note that rents have a little bit more affordability right now than you'll have as a home buyer. So they're like, well, now it's a sanctuary of affordability. Now this was written 5 days ago. Maybe this is a maybe this is an outlier and no one's going to write about this again, but it I could see people catching on. It's been 13 months or more, maybe like a year and a half since we've been noticing, the rents coming off of their highs. So hopefully people are starting to notice. Now, I don't know if this has anything to do with consumer sentiment, but it's mainstream media. It's certainly, I'm sure it was very difficult for this person to write about rents being low after writing about rents being high for 2 years solid. It's an easier narrative to write that and to not. So
because there's cognitive dissonance if you tell someone that the rents are lower. They're like, no, that's not true. Absolutely not. The rent's higher. They're like, I got my rent just increased by $200. That's not the case.
Yeah.
And so you have to separate the anecdotes from the actual data. And Matt, it's really interesting, especially when you're talking about the fact that, and we've talked about this a lot, about all the new data showing that new supply, new construction with any type of housing, market rate, luxury, affordable, whatever, and makes housing more affordable in general, can end up lowering the rents. I've seen Jay Parsons of RealPage start to call people who tried to say that building luxury units raises the cost of, calling them science deniers. And kind of or data deniers, but
that
specifically science deniers.
Yeah.
And they're getting looped into, the NIMBYs are getting looped into, whether it's flat earthing or whatever. Pick your conspiracy theory that doesn't have enough legs to talk about and have fun with. So it was really interesting.
Just like the story of perhaps a fake moon landing or a Bigfoot, there's a compelling narrative behind the story of, ever rising rents, and it's hard to shake away from. Flat Earth is kind of funny to invoke at this point. Yeah.
Okay.
So one thing that this article did add, and, other than just pointing to this pattern and pointing to this divergence between homeownership costs and rental costs. And you noted this before. It looks at the specific markets, so you can see, all right, which are these markets where renting has become a whole lot more affordable. Which are the markets where it's kind of in the middle, maybe increasing. Honestly, for multifamily investors, it is a good reminder that housing is a broader issue than just the multifamily market, and that there may be some interaction, and it's worth looking at the cost of living, in particular housing costs and home ownership costs in a specific market, and what that might mean for renters.
Yeah. Matt, I want to pivot real quick.
Yeah.
This is gonna, any update here, just because I think that those are all really interesting.
Yeah.
We'll keep watching it. Any updates, any thoughts on this ongoing case at the Department of Justice related to RealPage and the revenue management case? Article came out yesterday.
I didn't.
The DOJ has now opened a criminal probe into RealPage for price fixing. No longer a civil matter, but it's an actual criminal. I don't know if it's an indictment. It's not an indictment, but it's been brought to a level of an actual crime has been committed for price fixing. This seems to be incredibly heavy-handed.
Yeah.
And again, and so they're naming not just RealPage, but also some really large, huge REITs as well, including Essex Property Trust, Equity Residential, Camden Property Trust, and Greystar Real Estate Partners, which is more of a property management company. Apparently, this has been going on for 2 years. It started as a civil litigation that we talked about. I think it was last week that we talked about, Matt. But this is heating up, and it's really putting the multifamily industry in the crosshairs of the Biden administration. During an election year, using technology, which we've argued in the past that it's really just pricing information that other industries use to sense demand and forecast our pricing accordingly. Now, Great Capital, we don't use a lot of revenue management systems. We do in select cases, But
What?
most of the industry has switched over to much of the industry has switched over to this model, especially the
Um,
institutional larger managers. So go ahead, Matt.
this may feel like a stupid question. Why don't we use it? Just press the button, let the robot make the decisions.
Good. No, it's a good question. So one, there's costs associated with it.
Mhm.
And so you have to pay for it. You have to subscribe for it. In a property that's doing really well, we have a really good sense of the market.
Yeah.
We'd have to say, is it worth the cost? A property that's going now, someone from, revenue management company may push back. If you're doing a value add, it can be tricky because it doesn't exactly know what product type you have. And then has, you have unrenovated units, renovated units. You need to be a little bit more hands-on in that situation.
Mhm.
And some properties it's more appropriate for than others. And also if the rest of the market is doing it, you might want to, because you don't want to be kind of, left behind a little bit. But in cases where if you're the only one in the market that's using it, it's asset specific, asset and location specific, at least in our opinion, of whether it's appropriate to use or not. The argument is that you might be leaving some money on the table if you don't use it, but there's a cost associated with it. So how much money are you leaving on the table is the question.
Okay. No, it does seem like you're describing a tool, not like a conscious thinking, breathing thing. But that was my whole sense of this whole issue is the actors here, the people that, and I don't even say, I don't think that they're liable or anything, but if you're going to hold someone responsible, I don't think you should hold a algorithm responsible, but you should maybe perhaps in whatever situation they're describing, the people that use it. It's not, I think that it opens a huge can of worms about about this stuff if we're gonna fight against the purveyor of this information, even though like I said last week, you could get these landlords that are like, well, I just click what RealPage gives me and I don't really much think of it. It looks like that doesn't matter. You're still the one making that decision and you should be responsible. And it seems like, and I'm referencing another one, and I know we said that we'd follow up on the NAR case, sorry. And I do want to comment on that because I think that showed a little bit more clear cut of a case. It does seem like NAR had a stronger monopoly than whatever accounts for whatever RealPage, because RealPage is also in competition with other algorithms for rents, and NAR had specific things where it did seem like perhaps either individual agents were deceptive or they had something that encouraged actions that were a little bit more specific than this algorithm that presents the information there. And I'm just still trying to get it back to the human that's making the decision, right? And it is hard for me to imagine the rent in one case. And again, I'm going to mention gas prices. I'm sure that there's a software and that the owners of the gas station are not just making up the gas prices or just looking, and driving around town and figuring out what the averages are. They are probably using a source of that information, call it an algorithm, call it whatever, but they're not setting their own prices there. So why is it different for
and even beyond that, Matt, it's the gas stations, but also go another layer, deep in commodity pricing and trading. You don't think that there's information on what people are. How else do you trade commodities if you don't have access to that information? Now, I guess maybe the argument is that that's public information, and the rent levels is private, and so it's it's not readily available to everyone. But again, as we've mentioned before, Matt, you can go to apartments.com and see where everyone's rent is. You can do no one is getting secret information. At least not that I'm aware of.
And that's another thing too. I was thinking about is okay, renters can also make that choice too, and they have power to not move into that place if it has high prices. The only way that I can see it fitting as some kind of price fixing or that would be kind of that would run afoul of antitrust or whatever it is. I could see if you had one landlord for an entire chunk of the city, but I don't think that that's happening either. But if it is, then, maybe all bets are off. But that's the only situation that I can see price fixing working in like a whatever criminal or bad unethical way, is if you have a singular owner of a large area that prevents people that work near there. I gotta find a place near my work. Everything's artificially high. But here's my guess, is if someone tried to do that, the rents would be too high and people would move out of that area. I still think that it is ignoring, the consumer choice. And ultimately, again, and I feel like I'm wasting breath here, but I still gets me fired up, is like these algorithms, these services, they're responding to consumers. Consumers are doing one thing and they're responding to it. That's why, and blows me away, they are bringing this suit after a year in which real page rents decreased. So I don't know what their explanation is there. It's like, oh, well, we could have artificially increased it, but like we knew we were so evil that we decided to take a year off because we make the rents. It's not consumers that make the rents. We do it, so we dialed it down because we're nice guys. That's the imagination at work here. If you're going to assume that
the
an
mental
algorithm
gymnastics you have to jump through. So. Yeah. Wild.
Love it.
Okay, Matt. Sorry for that deviation. Wasn't on the planned agenda. I did mention it, but I did want to make sure that we stay on top of that piece. Because saw an article pop up, and we've mentioned it a couple of times. Now we can transition to talking about the cities, suburbs, millennials. Matt, there's two pieces. Mm-hmm. One for Moody's that I only want to just touch on for a second, and then I want to get into this JCH piece. So on the Moody's piece, it's written by who's it written by? It's by Thomas La Salvia.
Thomas La Salvia. Yes.
What's your take, Matt?
So,
or what did we learn? What's all the new data?
Not a whole lot of data, but it is a spark for a conversation. This is more of a, I don't want to say like speculative piece, but it is more kind of like from the top of the dome there. I would have loved to see information about some of the ideas that he is citing here, specifically things like this urban exodus that happened in the mid 20th century and how that maybe relates to now. And in this idea that actually, there was a time where, and here's a quote, where urban centers became a hollowed out, crime-ridden shell of their former selves, not seeing light for many decades. We get these wonderful passages, but not a whole lot of not a whole lot of numbers here. Like I would have known, okay, what percentage of people moved out during that hollowed out period, and how does that compare with now? I do think I have the same faith in the resilience of cities that the author has. I just am looking for more specific data to underlie it. One good point that I think he makes, and the reason why he thinks that perhaps people are going to stay in cities, is that people have their cities aren't full of office buildings alone. Maybe there's a little bit of residential, a little bit of retail, a little bit of office. There is a more heterogeneous makeup of building types, and I think that probably does mean you can last longer. I think that millennials are staying longer in cities, and we're going to talk about that in the Harvard Joint Center for Housing Studies article. But there are also aspects of this that need a little bit more data. Like he did say that child rearing continues to be delayed into later in life, which reduces the family push to the suburbs. And there's now wider spread wealth within the general urban population, which can act as a buffer to urban ills if and when they do appear. Now he's mentioning all these things, but and maybe that's not the purpose of this article, to like dig into every single detail that he says, but there are good ideas that would support the proposition that downtown's going to survive. I just, looking for a little bit more. I think that specifically, and the reason I picked this article up is that office performance is a specter. It is, it's kind of looming in a negative way over over the prospects of downtown in the future. And I don't know what's going to happen there. I know that it's going to get worse. And so what can we expect now? I think that he's onto something when he's talking about, well, now they're kind of giving different types of housing. And I think he notes this in a way that's like, is that true? What did he say? Something about like creative people like to go downtown, and that could be good. What did he say? And finally, the number of creative professionals, which tend to have a greater proclivity and or need for urban living, has increased in recent decades. I don't know where that, I don't know the numbers behind that, but I'm going to go on a limb and say people that like cheaper housing, if housing's cheaper, then they'll move downtown. I wonder if the recovery of downtown and is also dependent on how affordable it is. Artists can move in to that loft, to the cool, funky converted warehouse if it's cheap, but if it's super expensive, you'll have to have a patron in order to be an artist to survive downtown.
Yeah, it's more of are the yuppies, or they want to stick around rather than move to the suburbs. It's a good question. And I think that sometimes things can be so hyperbolic and talking about, when phrases of doom loop or doom loop get thrown around, and calling for the end to things. Mm-hmm. That I think is it gets clicks, it gets headlines, but it's just not accurate or misguided. A couple examples recently would be
I hope you're gonna say
like malls. Okay, a couple years ago, malls are dead. Like all malls are dead. Well, yeah, some malls, we did build too many malls, and some locations move and demographics change and shopping habits change. All retail people say is going to be dead because everyone's just going to be going on Amazon. But I think, where we've seen that as Amazon Amazon's opened physical retail stores.
Yeah. And that is such a good point. It's like, actually, you're mistaking growth, like the huge growth of something, for like a completely changed circumstance. Just because something's growing quick doesn't mean it's taken over.
Things shift and they adapt, and there can be periods in between where it seems like all is lost, or it's the uncertainty which leads us to our worst and greatest fears, because we don't know. I remember when, and the same thing with the commercial real estate, multifamily office, what have you. I remember back in the 2008 financial crisis, Matt, being told that, New York City, the streets of New York City are going to look like, I don't know why this has stuck with me. They're going to look like the streets of Jakarta. Jakarta might be a nice place, I don't know, but they're going to look, I don't know. They're going to look like the streets of Jakarta in a year or two. I thought you were going to say
San Francisco too. I thought they were going to, because that's the same stuff we're hearing about for San Francisco. Oh, have you seen? It is a, pick your description of a hellscape, and that's what people think is going on in San Francisco.
Escape LA, escape New York, and but it's also interesting because now San Francisco obviously has some problems, and a lot of cities do, and the West Coast cities, there's certainly a lot of the homeless issues become worse and worse, and it's expensive, and drugs and all that. But you also have to think back in the late in the 70s and the 80s, cities like all these cities, and especially cities like New York, were much more dangerous. The crime rates were much higher. They weren't all exciting places to go. Not that there weren't things going on, but even in those periods of like bad crime and drug use and all of that, people still went and they evolved, and most of these cities got cleaned up and got to a whole different place. Like New York City is a completely different city. Now it's facing other issues, the pandemic, people living, and taxes, and all the rest.
But even in the hollowed out, the 70s and 80s that he's talking about, where it was at the worst point. There were still very rich bankers.
Taxi driver era, right?
Yeah, exactly. But there were still at that same time very rich bankers and Wall Street traders and professionals of all stripes living and working there and making a lot of money. And having a great time. So it's not like, there's a lot of different sides to a city is for sure.
Exactly. And so we're going through another transition. And so, don't count cities out. Don't count any in general or specific cities just yet. Be more focused on what the solutions are going to be.
Yeah.
And then go same thing with asset classes, Matt. I wouldn't like the whole idea that office is dead forever.
Yeah.
I don't think
I
that's
agree.
true. I
Very
don't think,
much.
I think, yeah, ours do some build. It's like office is, I think the analog is much closer to
Mm.
malls
Yeah.
and maybe even less so because I think that like we will realize we do want physical places to work outside of our home. I
Hmm.
mean, I think it's gotten very trendy and is part of, the zeitgeist and the culture, like, oh, I'm working from home now. I'm never going back. That's fine. But like the next generation is not going to be doing that. Some
Yeah.
will. There's always going to be a remote hybrid component. That's all good and great. And it's going to let offices maybe be a little bit cheaper and people will take larger floor plans, maybe than they otherwise would have, for a similar cost, or maybe they'll scale down and only have, a couple meeting rooms, but
Hmm.
you're going to want to have a physical place. And what all that looks like, we don't know. And so the default is it's all going to zero. But just like in the CBRE piece we were talking about earlier, very specifically, they mentioned that there could be a generational wealth building opportunity for some select buyers in the office
Yeah.
space right now. So, most people like don't want to go near it. Most banks don't want to touch it. So for the savvy investor, the right deal, I've talked to a couple that are looking at it. Could be a great move. Let's
Yeah.
go to this Harvard piece though before
Totally.
things get too out of whack. Okay, so
Hmm.
after leading back to the city movement, many millennials moved to the suburbs. Matt, isn't this the case? You and I may not. Well, neither of us have lived like downtown Indy.
Right.
Um,
I'm just about
but
to do something.
we live in it. We live in Indy, more like Midtown.
Yeah, so I'm going to do something different and just
Oh
say
my
the thing that I wrote last on my notes first. And
Okay.
it's something that she doesn't note here, but I think about schools a lot.
Mm.
Why? And
Ding.
for me, and I could be complete. This is just like my own sense of things, and I don't know where the suburbs start in Indianapolis. I certainly don't think that they start when you get outside of Marion County. I think that there is a suburbs of Indianapolis that's far within, the city limits of like whatever the MSA is. So, but with that being said, as you go outside, as you go, away from the urban core, the amount of schools are more. There are less schools in the downtown versus as you get farther away from downtown. Now, I could be wrong. That's just my sense of things, and that kind of goes in the same direction as the types of decisions that millennials are making right now across the country. Is they're going places and thinking about their kids. It's a life stage thing, and I know the bulk of this article, and it does. The new information that it provides is that affordability is a factor here when it comes to, but I would have loved a little bit more of a breakdown on the article says life stages and changing housing needs. Well, what are they? Do you need more bedrooms? Do you need a yard? How much is schools a factor? Now, it's not like there's zero schools downtown in Indianapolis. It's just you have less to choose from maybe than elsewhere. Commute times. There's a lot of different factors that go into where you're picking, where you're moving, and it's not just suburbs and urban. I think that what ultimately though, like despite all these factors that mean that millennials are moving out, they are on the whole staying in downtowns much more than previous generations. So that's another thing that I think that this Harvard article could have emphasized more is that actually, it could be worse. There could be more millennials staying behind, and I know they mentioned Gen Z as this source of continued strength in the cities as they come to live downtown. But I would be more interested, and I think be very compelling if there is a cross-generational trend of people staying downtown, because what is the most interesting to me, at least in my lifetime, when it comes to the revival really of places like Indianapolis, is it does seem like man, the downtown got a whole lot nicer after, like 2010 or whatever. I always said like after the Super Bowl came to Indianapolis, and I think that coincided with a general movement into the cities by millennials, maybe young people that were in that stage of their life. But man, it seemed like they revived downtowns, and there's a different feel of downtown and a different makeup of downtown than there was, in the times that the Moody's article was written
Yeah,
about.
and I think that's reflected, jumping outside of Indianapolis, I think that
Mm-hmm.
it is looking at a lot of demographic shifts, and millennials are the largest cohort, and they're graduating from college, getting out of
Mm-hmm.
college kind of in the 2010s era, or at least a bunch of them were. And yeah, moving downtown, yeah, that's where a lot of the jobs were. Working remote wasn't a big thing yet.
Yep.
And, downtowns were exciting. It was, why would you want to go to the suburbs? Again, we've talked about this repeatedly
Yep.
on the show, Matt. The idea of the suburbs, like that's where our parents live. There's nothing really going on out there. That's just where you
Mm-hmm.
can go and get a house. And that has, changed considerably. And while, I think the data is showing that the exodus isn't happening as quick as it could, again, a lot of examples, again, just personal experiences talking to people who were like, I mean, it's hard to count of people who are diehard, not moving to the suburbs people. And then they're like, yeah, we're moving out to the suburbs because, whether it's school, like you mentioned, there are
Mm-hmm.
more schools. Typically, the better schools are going to be in the suburbs, just statistically, and that's a big driver. They want the space, and if you try to look
Mm-hmm.
for existing homes, like you're not built, you don't have the room to build a ton of new homes,
Yep.
in a city. If it may be condos, townhomes, or apartments, and a home here or there, if you can find a lot, but the homes that are available are all out in the suburbs, and so
Yep.
you're kind of like limited. Plus, there's things going on in the suburbs, so there's actually a draw. In addition to schools, there's dining, entertainment stuff to do. Um, it's going to be fascinating how it plays out, but it will be interesting because the multifamily space over the last 10 years or so has been so focused on urban development,
Mm-hmm.
because of that. So now there's a lot of supply downtown, which could make and is making rents somewhat more affordable in those
Mm-hmm.
downtowns. That allows us creative people like we were talking about, and
Yep.
just
Yep.
young people who are kind of target, renting demographics. Maybe keep them around the suburbs a little bit longer.
Yep.
It's a really good point.
Yeah. I'm thinking of how much of a deal you get even with a house in the suburbs. And like, these are nice new houses. They're bigger and they're cheaper too. You get more land, you get a bigger house, probably newer. And then if you're home shopping, even for rentals, if you're home shopping for a place that's closer to downtown, that's not even that's maybe just less suburban even. So comparing like where I live to like maybe outside the county or whatever,
Mm-hmm.
it's a world of difference. You could probably get 50% more home for your money if you live in some of these suburbs versus some of these places that are closer to the city, not even downtown. And that's something that I think is worth exploring too, is this spectrum of, it's not just, there's no gate that closes, and it's downtown on this side and suburbs on this side. There definitely is like a spectrum, and there's pockets of suburbs and pockets of downtown areas that what I hope is that, and maybe this is just like nostalgic and or whatever. I hope that there is a persistent interest in downtown, and I wonder if the effects of whatever's happening in the office market could maybe be to the benefit of a presence downtown by people that live there, and a larger community of people that don't hollow it out. I don't think that office conversions into multifamily are feasible on the whole, but tear down these places, maybe make more apartments, let people live there more, and that's that would be a little bit more vibrant. I don't know.
Just turn them on the data centers,
Yeah, that's
which
true.
probably
Okay.
doesn't probably even harder
Yeah.
than the residential conversion. But
Yeah.
it'll be interesting to see. I wouldn't write off cities. I wouldn't write off office.
Yeah.
Not completely. Are they going to go down through a period of uncertainty and declines and reshaping and reimagining? For sure. But it'll be fascinating to see what comes out on the other side.
Yep.
Matt, this is a great report. Great episode. Anything else on your agenda or whether you are going to be watching over this next week and whatever else you'll be watching?
You know what I'm going to be watching? I'm going to be rewatching the 3 really excellent guests that we had on the Gray Report. We had research director from Yardi Matrix, Paul Fiorilla. We had Grant Cardone came on to and then we also had research and analysis director at RealPage, Carl Whitaker. So a lot of these experts, and there's more to come. So I am feverishly reaching out to all. And if you are listening right now and you are a housing expert, feel free to contact me, Matt at graycapitalllc.com. Feel free to email me. Everyone else already seems to know my email. So come at me, please send me an email. And if you're an expert, I would love to have you on the show.
Cool. Yeah. All right. You heard it here first. Taking submissions for a guest on the Gray Report. Yeah, I'm going to go listen. I need to re-listen to those episodes, Matt. They're really great conversations with Paul, Carl, and Grant. And you can find all of those on the Gray Capital YouTube channel, which you should subscribe to. If you are not subscribed, definitely like this video because you've watched the whole thing. You get a gold star. So leave a comment as well. All right. Thanks again, Matt. Keep it together in the office for us.
You too. Take it easy.
Keep an eye on everybody.
Will do.
All be good. All right. Talk to you soon. See you soon, everybody. Bye.